I had a conversation the other day that really just sums up the whole story of American retail right now.
Oh, yeah.
Yeah, I got a call from this investor. He's based in Chicago.
Yeah.
And he was just so frustrated. He said his properties were, and I'm quoting him, hemorrhaging money,
I've heard that story before.
right? Vacancies climbing, tenants wanting concessions on everything. But his partner, who had moved all their capital down to Dallas a few years back, was buying properties left and right. Seemed totally fine.
Mm-hmm.
So the question he asked me, and it's the question for our deep dive today, was simply, what's going on down there?
It's the million-dollar question.
It is. So today we're unpacking this Eureka Business Group analysis of the Dallas-Fort Worth retail market in 2025. This was a year where DFW didn't just do well, it beat every other major U.S. market.
And by a lot.
A lot. And our mission here is to ask that critical question. Would the data make you invest your own money?
And what's crucial to understand is that this wasn't luck. It wasn't hype. What happened in DFW was the result of, very real, very sustainable economic forces. And that's the story we need to tell.
Okay, so let's get into the numbers. The performance that kind of stunned Wall Street. We have to start with the most basic metric, right? Vacancy rates.
Always. It's supply and demand in one number.
Exactly. So DFW closed out 2024 at a very tight 4.7% vacancy. But the really amazing part is that for 2025, it was on track to close the year below 4.6%.
Which is just, you have to understand that's the lowest it's been in more than 15 years.
And to put that in perspective for everyone listening, what was the national average at the time?
The national average was hovering around 7.5%, so a huge gap.
A massive gap.
And if you look at a market like, say, San Francisco, they were struggling with vacancy hitting 12.8%.
Wow.
So that difference, it isn't just a statistic. It represents a fundamental power shift from the tenant straight over to the property owner.
Okay, so low vacancy is great for stability.
Yeah.
But the real wealth creation, that happens with rent growth. Did that power shift translate into higher rents?
Oh, absolutely. It did, and in a big way.
Okay.
So while the rest of the country was sort of sputtering along below 3% rent growth, DFW was averaging a really powerful 4.6%.
And these are rents that were actually being paid, not just asking rents.
Exactly, because the competition for space was just that fierce.
I know the source material had a pretty incredible real-world example of this. Can you walk us through that one?
Yeah, this one was a perfect case study. We were working with a client. They owned a small grocery-anchored center in North Dallas. Pretty standard.
Mm-hmm.
But a national anchor tenant's lease was up for renewal. And because the market was so tight, the owner had all the leverage.
So what did they get?
We secured a 36% rent increase over the next 5 years.
36%.
36. And the key thing for investors to hear is how it was structured. It was front-loaded with a 10% bump. Boom, right at renewal.
And that was possible just because that anchor tenant couldn't go anywhere else.
They had nowhere to go. In a market with under 5% vacancy, moving would have been a massive disruption. The supply just wasn't there.
Okay, a 36% rent hike, that's just not sustainable unless consumer spending is going through the roof. So that pivots us to the why, the economic engines.
Right.
And it all starts with jobs. Retail follows jobs. And in 2025, DFW added 48,000 net new jobs, one of the highest totals in the country.
And it's not just the number of jobs, it's the quality of those jobs. That's the key.
That's a great point. The average salary for these new positions was over $68,000 a year.
See, that's real purchasing power. That's what fuels demand for better retail, better restaurants, better services.
And a lot of this was driven by corporate relocations, right?
Yeah.
Companies leaving high-tax states.
Exactly. You think about the ripple effect.
Mm-hmm.
A tech company moves, say, 500 high-earning employees to Plano.
Right.
Instantly, those 500 families need groceries, they need coffee shops, they need dentists, and all that demand just immediately soaks up the existing retail space.
Which brings us to the other half of the equation you mentioned earlier, the supply side.
The supply constraint, yes. So while you have this incredible surge in demand, the supply of new retail space was artificially low.
How so?
Well, a mix of things. Municipal approvals taking forever, labor shortages, and just the rising cost of materials.
So it's just harder to build new stuff.
Much harder. The data showed that DFW actually issued fewer retail construction permits in 2024 than it did in the years before. That created this, what we call a monopolistic position for existing landlords.
So basically, high barriers to entry meant existing owners could cash in without worrying about new competition popping up next door.
You've got it. It was a predictable supply-demand imbalance.
Let's talk about the other demand driver.
Yeah.
People. The demographic destiny, and the analysis calls it.
Yeah, the population growth numbers are just staggering.
DFW's growth in 2025 was 1.16%. That's nearly double the national average.
And it's where that growth is concentrated.
Ah.
The fastest growing city in the entire country, Princeton, Texas.
Right here in DFW.
And the fastest growing county, Kaufman County. Also right here.
And again, like with the jobs, it's about the quality of that growth.
Exactly. The new people moving in had household incomes that were, on average, 25% higher than the existing median.
So you're getting more people, and you're getting wealthier people.
Wealthier people in their peak spending years. The 25 to 44 age group, the people starting families and buying things, that group grew faster in DFW than any other major metro.
There was that anecdote about Selena that really brings this to life.
Oh, Selena's a perfect example. The population literally doubled between 2020 and 2024.
Doubled.
And by early 2025, every single retail space was full. We were seeing restaurants with hour-long waits on a Tuesday night. That's what happens when residential growth outpaces retail infrastructure. It's a goldmine for property owners.
So you have jobs, you have people, but all that momentum needs a foundation to stand on. Let's talk about infrastructure investment.
A huge piece of the puzzle.
The Texas Transportation Commission put an incredible $12.8 billion toward DFW highway improvements, scheduled out through 2027.
And what that does is it creates predictable catalysts.
Explain what you mean by that.
Well, when an investor sees that a highway like US 380 is guaranteed to be expanded, it completely de-risks the land around it.
So you know the traffic is coming.
You know the access is coming, the value goes up before they even break ground, and you see the same thing with the DART rail expansion and the big projects at DFW Airport. It's public money creating clear, predictable, private opportunities.
So now let's go back to my friend, the investor from Chicago. Let's contrast DFW's situation with what was happening elsewhere.
This is where location becomes everything.
So while DFW is under 5% vacancy, Los Angeles was climbing past 9%.
Driven by high operating costs and businesses just leaving the state.
And New York.
Manhattan saw vacancy levels they hadn't seen since the 2008 crisis. A lot of that was due to regulatory uncertainty, things like commercial rent control that just spooked investors.
And Chicago itself was dealing with a whole mix of problems.
A multifaceted problem, yeah. You had rising property taxes, city budget issues, safety concerns. It all created this negative feedback loop.
Which explains why all the big national retail chains were pointing their expansion dollars in one direction.
Straight to DFW. They were actively moving resources out of those struggling markets and putting them right here in North Texas to capture that reliable demand.
Okay, so given all these factors lining up perfectly, what was the winning investment strategy in 2025?
The key was to look where the growth was going, not where it had already been. Properties in the path of that demographic surge way outperformed the already established, saturated districts.
You had to look north and east.
You did. And two types of properties were especially resilient. First, grocery-anchored centers. People always need to eat.
Non-discretionary spending. Safe.
Very safe.
Yeah.
And second, properties with a lot of medical and service tenants. Think dentists, vets, tutoring centers. They sign longer leases. They have built-in rent increases. Very stable.
So it wasn't just about buying any property in DFW.
No, the smartest play was value add. The really successful investors were finding underperforming properties, maybe a little rundown, but located squarely in the path of growth places like Salina or Princeton.
And then fixing them up.
Exactly. They'd invest in renovations, bring in those better tenants, and capture returns from both the rising market rents and the value they created themselves.
It sounds like 2025 was a real inflection point. Does that mean that window of opportunity is closing?
That's the critical timing question. The short answer is no, not yet.
Okay.
The corporate relocations that have already been announced mean 2026 should continue this trajectory. But the window to get properties at what you might call pre-performance pricing is definitely getting smaller.
The secret is out.
The secret is out. National and institutional money is here now, and that means more competition for the best assets.
So to sort of wrap up the analysis, DFW's outperformance, it's not a fluke. It's the predictable outcome of all these compounding advantages.
It's business-friendly rules, it's population growth, it's controlled supply, and it's massive infrastructure spending all working together.
The bottom line is all the fundamental drivers were aligned.
Perfectly aligned. And this performance gap between DFW and the rest of the country is probably going to get wider, not smaller. The investors who build generational wealth are the ones who act on this kind of fundamental analysis.
So if we circle all the way back to that Chicago investor, His problem wasn't just his properties, it was his market.
100%.
If he had just followed the flow of people and capital, he could have been seeing the same success as his partner in Dallas.
No question.
So I think the final thought for you, the listener, is that the numbers don't lie. DFW retail crushed every other major market in 2025. The real question for a serious investor isn't if it will continue to outperform, but whether you will position your capital to be a part of it.
Well said.
For those of you who are ready to see how these dynamics could align with your own goals, we want to point you to the original analysis by its author, Joseph Goslan. He's a broker and commercial real estate advisor with the Eureka Business Group. They're located at 5760 Legacy Drive, Suite B3 127 in Plano, Texas, 75024. And you can also reach out by phone at 903-600-0616.